Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Josh Lipton alongside Alexander Canal, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There are multiple paths to 50. I think the most straightforward is first the inflation data. We have made massive improvement with the federal funds rate still very elevated. It's time to cut. That's your 25 basis points just on the progress with inflation. It's what the Fed asked for. They got it. They can cut 25.
You have to look at the fundamentals for the long-term value of stocks you put in your portfolio. Earnings are really going to be the big driver. So even though now we might be distracted by all the Fed speak, ultimately, what companies can produce in terms of earnings really is going to drive their valuations. And even now, that's what we saw with those other 493. It's been earnings that have delivered for them, that have driven valuations higher.
If a ban were to occur, the brands that would be most impacted are the small, medium businesses. Why? Because TikTok is one of the last places on the internet where organic content can reign. In all the other platforms, it's a pay-to-play environment. And so if you're an up-and-coming brand or retailer, TikTok is the place where you can get traction with just your blood, sweat, and tears.
We've got 1 hour to go until the market closes. We're taking a look at the major indexes, trading mixed across the board here. We're seeing the Dow up about 0.6%, the S&P 500 trading flat, but the Nasdaq, the biggest laggard of the day, down about 0.6%. And it seems like, Josh, markets are in wait and see mode in the countdown to the Federal Reserve on Wednesday. If we take a look under the hood at the Nasdaq, you're seeing Apple dragging down that index at large, down about 3%, Nvidia down about 2%, and Apple is a story that we're going to be digging into a little deeper later in the show. Pre-orders for their latest iPhone falling short of expectations, and that's one of the reasons why we're seeing the stock drag down. I also want to take a look at what's happening in the bond market, what's happening with yields. There's obviously going to be a ripple effect, whatever the Fed decides to do there. You're seeing the 10-year Treasury yield trading down about 3 basis points. We're trading around 3.6%. Same thing with the 30-year, down about 4 basis points, 3.94%. And I also want to take a quick check at Bitcoin. Another thing trading to the downside today. We're hovering just below 58,000 a coin. Bitcoin also awaiting the Fed decision. So this is a big week for markets. We will have an update on the consumer with the latest retail sales numbers out tomorrow, but the Fed is certainly the highlight here.
Yeah, I think you hit two big kind of cross currents. I mean, you have the Fed decision, right? And I think you're exactly right, Alex. There's a little bit of perhaps wait and see mode going on there. It's interesting how bets for the supersized half-point cut have grown. In fact, Greg Ip, noted columnist for Wall Street Journal, out with a new one saying, yes, the Fed should cut by half a point. We have Greg on later today and asking for a trend. And I think Apple is a really important story today, too. It's under pressure. The point being, you really had a well-known, well-respected analyst, Ming-Chi Kuo, kind of combing through the pre-orders data and concluding, you know what, issued sort of this warning about weaker iPhone 16 demand, and that's weighing on the shares.
And really the status of Apple Intelligence as well. We know that AI trade has been alive and well for many investors, but we've seen this cautiousness, I would say, when it comes to the appetite there and on future demand and the chip sector and AI play at large is something else we're also going to be digging into a little bit later.
All right, for more on what to expect from the Federal Reserve this week, let's welcome in Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, always good to see you. Let's start there with that Fed decision, Michael, and I'm interested to get your take on what the Fed will do and what you think they should do.
Yeah, it's funny. It could be two different answers. And for me, it is our firm thinks the Fed, we're leaning towards a 25 basis point cut, just given how Powell has spoken about things. And I think I think he wants to avoid maybe doing 50 unless it's really necessary to set the expectation they're going to be cutting rates that quickly. But on the flip side, I think they should do 50. And I guess we'll see how confident Powell really is. You know, he made us wait this long until he said he was confident. And confident to me is 50, but we'll see. But we're leaning towards 25 basis points.
Leaning towards 25, but Michael, you did mention expectations there, and the markets, they're leaning now towards 50. So could you argue that the Fed would actually be tightening policy if they went with 25? And you think markets would be upset by just a 25 basis point cut at this point?
No, I don't think in terms of the economy, I don't think it makes a big difference whether they go 25 or 50 this week. For the markets, perhaps given, we'll see tomorrow, we're going to get retail sales and that can shift things around. Obviously, that's a widely followed data point. And so I don't think we'll see a massive sell-off if they do 25. And I think really what's going to be important is what is in the statement, what is in the SEP, and what Powell says about going forward and about the pace and of rate cuts going forward.
And what do you think? I agree, Michael. It's after September, it's going to be a big focus on just the path and degree of cuts after that. So what would you be expecting?
We're expecting to see a slightly higher unemployment rate in the SEP. I think the Fed was at 4.0 and 4.1 for next year. So I imagine that's going to tick up because obviously we're above that. And most signs of the labor market continue to show this kind of slow softening that we've been seeing for some time. And within, inflation probably is going to be ticked slightly lower, perhaps not at their target anytime soon, but I think low enough.
And then part of the SEP is going to be the Fed dot plot, which maps out what policymakers, where they think interest rates are going to head towards the end of the year. Markets are currently pricing in about 100 basis points worth of cuts. Is that realistic?
It's possible, certainly, and I think it really depends on the employment data rather than the inflation data. I think inflation is very much old news, and that's been the case since the unemployment rate started rising. So I think we'll hear in the Fed statement that recently we're in better balance, and now I think Powell will say we're balanced, which is kind of what he's led us towards over the last several meetings.
Michael, we're talking a lot about the Fed. I want to switch gears and talk about earnings, because that next earnings season is coming up pretty soon here. What are your expectations, Michael, for corporate profit growth?
So, I think we're going to see more of the same, which is that larger companies' earnings will continue to be more or less resilient, led by the larger companies, not just 7 stocks, but just in general, companies with better economies of scale and more efficiencies. And on the flip side, when we look at mid-cap stocks or small cap stocks, we believe we'll continue to see their earnings disappoint, and we'll see that through expectations for earnings for 2024 and 2025 to continue falling. For this year, 2024 earnings are now expected to fall below 2023's earnings for both mid and small cap stocks. So I think we're going to see more of the same. Last week, we got the NFIB Small Business Survey that comes out each month, and their actual earnings fell to the lowest levels in about 15 years. So I think there's still a lot of bifurcation in this economy, and that's ultimately why the Fed, I think, is going to cut.
So more of the same when it comes to earnings. You mentioned larger companies with better scale. Do you have specific names that you're watching that we could see more of an outperformance?
Well, what we're looking for now, so we've been bullish all year up until the beginning of August on the view that softer employment data and moderating inflation data would be really good for equities, and lower rates would pull stocks higher. Now that we've seen the unemployment rate creep up and inflation really fall down pretty sharply, pretty close to the Fed's range that they want to be in, I think there's not much more PE expansion left for equities. So I think markets are going to chop sideways for the rest of the year. And so we wrote a note today highlighting that stocks to really appreciate and now perform from here are really going to have to earn their returns, i.e. see better earnings revisions. So we published a broader list of stocks that have the strongest earnings revisions across markets. And that's what we'd be focusing on going forward. And again, in the last year and a half, markets are up a lot, but the majority of that has come from PE expansion. I think now it's going to be really all about earnings.
So when you screen for that, Michael, what are some names that popped up?
Well, so we look at things cross-sectionally. So there's not any specific one sector. But if you give me a second here, I'll pull up. We do quantitative research, so we're not looking for 1 or 2 names. We're looking for baskets of names. But I can give you a handful of names that have strong earnings revisions that also have good fundamentals. Again, some of the larger cap tech names, Netflix and Meta, both have strong earnings revisions within their sector. other financial companies, a lot of insurance companies, Progressive, Global Life, within some of the more industrial spaces, Wabtec, building products like Train Technologies, that's ticker TT, and then some utilities, which has been my favorite sector, NRG Energy and American Waterworks. They all screen for stocks. They all screen for having the strongest revisions within their respective sectors.
Finally, Michael, get you out here on this. Looming election. Your clients come to you, Michael. They're long-term investors. They say, how much should I be focusing on this, Michael? Should I be tweaking my portfolio? You say what?
Well, I don't think right now, and there's very idiosyncratic bets investors will be taking in the energy space, EV space, healthcare, and the healthcare space that tend to get whipped around, that are where policies are most polarized between the two candidates. But as of now, our policy team still think that it's a coin toss in terms of who's going to win. And I think ultimately, when our policy team polled clients, the answer for the best market backdrop that they said would be a Harris win with a split Congress. So not getting any kind of some of those more extreme tax hikes, corporate, personal, and with Trump not in office, not getting huge tariff increases, which he could do unilaterally.
All right, we'll wait and see. Michael, thanks as always for joining the show. Appreciate it.
All right, thanks, guys.
And we're just getting started here on market domination. Coming up, Boeing shares lower today as the company is implementing a hiring freeze and considering temporary furloughs. Going to be breaking it all down on the other side. Plus, Apple shares under pressure on a report of weak iPhone 16 pre-orders. Going to speak to an analyst about the tech giant later in the hour. Stick around, all that and more when market domination returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Turbulence continues on Boeing's road to recovery. The aerospace giant launching efforts to preserve cash amid an ongoing strike of more than 33,000 Boeing workers. Cost-saving measures include instituting a hiring freeze and planning significant reductions in supplier expenditures. And joining us now is Morningstar equity analyst Nicholas Owens. Nicholas, it's good to see you. And maybe we'll just start there with that headline. Nicholas, Boeing freezing hiring. Sounds like there could be hunkering down there for potentially a drawn-out strike. I'm curious, just a financial analyst, Nicholas, who knows the company so well, what'd you make of that report and headline?
Thanks for having me, Josh. I think it's a logical thing to do. Lots of companies do hiring freezes whenever they're going through any sort of budget crunch, and it's a prudent step. I doubt it'll offset the damage from the strike, but they just have been, I'd say for months now, have been making plans to preserve cash to get through the end of the year.
And clearly management seems the strike as being material to the bottom line of this company. So is there a ticking timeline of sorts where if the strike is not resolved by X date or an X amount of time, we're really going to see the bleeding accelerate at this company?
Yeah, well, I hadn't thought about it that way in terms of the timing of the strike. I think that they have a lot of pressure to get their assembly line back in good order, and this strike interferes with that and delays any progress they were making on basically recertifying their assembly process for planes like the 737. They're going to start running up into holidays at the end of the year, and so that resolving it before then would be beneficial because there's going to be work lost sort of towards the end of the year anyway. But the irony is they're not paying the machinists while they're on strike, but it's the disruption of everything else and loss of productivity on those assembly lines that's going to cost them.
And have you tried to game that out, Nick? Just try to estimate the financial impact Boeing could be looking at here for every week that these workers are on the picket line?
I didn't do it by week, and it's actually kind of strange because they're currently losing money on making airplanes. So if you say they're not going to build any airplanes this quarter, it actually improves their profitability sort of in a little model exercise. The impact that I see from the strike has more to do with pushing further down the road the time that they will be able to ramp back up a sort of clean assembly process, get the 737s and 787s out the door squeaky clean, which that timeline has been pushed back now several times into, let's say, the 2027 timeframe.
Have you tried to think through, Nick, what a potential deal could look like, what agreement that the two sides, the workers and management, could actually shake hands on and move on?
Yeah, and there are lots of moving parts in these deals with the fine print of the retirement plan and health plans and so forth. The big number that was floating out there of what I think labor observers were talking about a 40% total increases over the life of the contract was what some union members were expecting. And when the new contract was proposed with a 25% total increases, I think that was disappointing. So when I put pencil to paper and tried to estimate what I think the outcome will be, I'm just using the sort of 40% of increases as my benchmark, as that is probably something that would resolve the issue. And that's how I model sort of the financial impact there.
So how realistic is it that the workers will receive that? And at the same time, how much leverage do they have at this moment in time? I mean, Boeing has a lot of issues even outside of these strikes.
Yeah, I mean, I think the question of leverage is an interesting one, especially when you look at kind of the long history between Boeing and this union. 2008 was the last time they had a negotiation as well as strikes, and the company was somewhat aggressive in, let's say, using negotiating, stance, moving production of the 787 outside of the unionized, Puget Sound, even eventually moving their headquarters outside of there. Those moves, I think, antagonized the union, and so that's one of the reasons they didn't approve the deal. Was almost just as a an emotional kind of response, right? The likelihood that they'll get to a new deal, I think, is high because right now Boeing has, I think, almost no leverage. If you look at their own situation, the history I was just talking about, and then you look at sort of similar or comparable agreements that have been signed by airlines, by the automobile manufacturers, that's where I kind of come up with also these benchmarks that 40% over 4 years is not outside the realm of possibility.
And finally, Nick, just as an analyst, if you were looking for possible potential catalysts for this stock, near, intermediate term, what would be on your radar?
Yeah, and I've learned that Boeing can have more bad headlines before the good ones start coming through. But some good headlines that I'd be looking forward to, progress, and milestones that they have coming up. Things like they've delivered the last of the 737s to Chinese customers. They've started up, regular production 787. Anything for them to show that they are moving out of this bogged down state. They basically have parallel assembly lines for both the 737 and 787 where they're reworking the planes before they can ship them out. It's the sooner they can get to where the parts come in and the planes go out without rework and doubling down and double time, that will have a dramatic impact on the company's profitability and cash flow. And that's essentially what I think everyone at the company is working towards.
Nick Owens from Morningstar, thank you so much for your time today. I appreciate it.
Thanks for having me.
Big tech companies are investing millions on artificial intelligence, but it's still unclear when investors will see the return on that investment. And chip stocks have been taken along on a wild ride as a result. For more, we're bringing in Ruben Roy, applied technology analyst at Stifel. And Ruben, we know these big tech giants, these hyperscalers, they're aggressively spending on AI, but we've also seen the volatile swings these past few months. So from an investor perspective, what are the biggest concerns that you're hearing from your clients?
Yes, hi, thank you for having me. Certainly, I would say the number one question we're getting is this investor debate around, as you said, all of this investment that we've seen now going on, 2 years, relative to ROI or returns on the infrastructure investment. Where's the beef or where's the money on some of the infrastructure that's being built out? So from an investor perspective, it certainly seems like there are concerns as we look ahead to 2025 as to the sustainability of the CapEx spending from the big cloud service providers, whether or not investment spending will extend into Fortune 500 enterprise, and what's next for the big suppliers of hardware into the investment cycle, like NVIDIA, for instance. And so certainly that's top of mind for investors. And, it's been reflected in the volatility, as you mentioned, in the stock, NVIDIA underperforming the S&P 500 over the last 3 months, but certainly having a very strong year to date, nonetheless.
Top of mind for those NVIDIA investors, Ruben, also is what demand looks like for that new Blackwell chip. What are your checks suggesting there?
The checks have been solid. And it's not just Blackwell. There were a lot of concerns heading into NVIDIA's quarterly report late August around timing of Blackwell, whether or not NVIDIA was having some technical difficulties with Blackwell. But certainly coming out of that report, certainly I would think would ease some investor concerns. The numbers were solid with a nice beat for the July quarter and a nice raise relative to consensus expectations for the October quarter. And Blackwell hasn't started shipping yet. I mean, we're talking still about a lot of demand for the existing Hopper architecture. And if you kind of look through and speak to the supply chain or look at some of the supply chain commentary, certainly it would sound like demand continues to far outpace supply. And so when we look at 2025, I think something that investors should take into consideration is that Blackwell is not one product. It's not a GPU. It's a lot of different configurations of systems that NVIDIA is going to be selling into a lot of different types of AI infrastructure builds. I would say one thing that really becoming evident, we saw OpenAI unveil their O1 LLM over the weekend, is that the size of the AI clusters is moving higher. And I think that that's really, really interesting as you think about NVIDIA's positioning in AI, not just, like I said, GPUs, but system software and the overall infrastructure that's required for AI.
So Blackwell demand strong, but I do want to go back to a point you made earlier that investors are concerned about the sustainability of this spending from these big tech players. Are there any signs that investors can look out for ahead of NVIDIA earnings when you're looking at that demand picture and whether there is a slowdown of spending?
Certainly in this type of spending and the rate at which spending has been growing, which we've never seen in covering the space for in excess of 20 years, it's not sustainable for, forever, right? So at some point there will be digestion periods ahead. What are some signs that investors can look for, or, signs of progress for the AI infrastructure vendors like an NVIDIA? Is that in our view, we haven't even really broached I think the extent to which AI is going to impact a lot of different industries. We're building out these training clusters, and we're putting into place large language models. But I think there's a long tail investment cycle coming beyond this, which is going to take the data that's being generated by the language models and then actually doing something with that data. So the so-called training of models, moving to inference of those models and putting that data to work. And I think NVIDIA and others, we cover AMD, which we like very much, are building infrastructure around their hardware. So adding a lot of different types of software resources to their hardware to get ready for that longer tailed investment cycle. And so while the numbers may not continue to grow at the rates that we've seen, it's going to be interesting to us to see where the spend is going to flow, right? Is it going to flow into some areas of software that NVIDIA is expanding into? Is it going to flow into other areas of hardware that we haven't seen yet? We'd like to think about AI at the edge, AI moving into things like personal computers, mobile handsets, even automobiles. And so I think, we're going to see a lot of these companies expand their approach to AI to address a lot of these end markets and benefit as the spend moves around from, again, what we're seeing today, which is the core infrastructure around large language models.
And Ruben, I want to switch gears, talk about another name you cover, and that's Intel. I did see some headlines, Ruben. Intel was awarded up to $3 billion by the Biden administration under the CHIPS Act. Stock was higher today, but it's down. I'm just looking at Ruben, about 60% now this year. What is Intel's future? Does it remain as is, or no? We're going to have to see some meaningful, dramatic changes there.
Yeah, I think we've started to see some meaningful, dramatic changes for the first time in its history. 50-plus year history. Intel is internally separating the way they operate their design business versus their manufacturing business. Longer term, are we going to see additional changes, maybe a separation of those two businesses? Unclear. But certainly, the company, unfortunately, has missed a lot of this initial investment into AI infrastructure. They just have not been present. And, with that in mind, I think there's a lot of catching up to do, and there's got to be a lot of change and transformation within the company. It's great to see announcements like we saw this morning, extension of the CHIPS Act monies going to Intel. I think, having U.S.-based manufacturing is a must, and I think Intel's positioned to benefit, given their historical leadership in manufacturing technologies and IP. Yet, there's more to come. We need to see more traction along those lines, not just with the U.S. government and, kind of these deals that have been announced, but, sort of real traction with the companies that are running the leading edge of AI infrastructure build out, whether that's NVIDIA or AMD or companies like Broadcom, Marvell, and others, Qualcomm. Those are the companies that we'd like to see kind of transition over to some manufacturing away from, dependence on overseas manufacturing and bring that in-house or onshore, I should say, to Intel. We haven't seen that yet. We haven't seen that in volumes yet. And I think until we start to see that, sort of the investment case for Intel is still sort of an unknown.
And let me ask you, Ruben, listen, when the stock gets hammered like Intel is, a question will be is whether, Pat Gelsinger is the right man for this job, the right CEO for this job. What's your opinion there?
I think Pat's heart is in the right place. I think he came into a situation that required a lot of heavy lifting, and they've done a lot of heavy lifting. There's more to do. Unfortunately, I think that Pat overestimated the time with which it would take him to kind of complete a large overhaul. Not to take anything away from, the strategy of getting 5 manufacturing process nodes out into the marketplace in 4 years, which I think Intel was successfully. doing. I think that's, it's great, but there's a lot of work behind that. And so now we're going through a painful workforce reduction. There's a lot of moving parts with the manufacturing business. We've seen pushouts in the timing at which Intel is going to potentially put some of this manufacturing capacity to work. I think there's still a lot of questions, like I mentioned, around the company's strategy on AI itself and how it's going to address this market that seems to be moving away from them. So to your question, Josh, is Pat the right guy? Hard to say at this point. We never like to see high profile members of the board leaving like we saw a few weeks back. And so I think, it's a question that we'll get an answer sooner rather than later as investors continue to grapple with, how Intel is going to grapple with the complexities of challenges ahead over the next couple of years.
And Ruben, I want to end on a name that you are bullish on, and that is AMD. You've mentioned that company several times. And look, this is a company that has been at the center of a lot of M&A recently. What sort of acquisitions are we seeing from AMD, and how does that change the competitive landscape here?
Yeah, and that's a really interesting topic, I think, because, whereas Intel is, trying to reestablish itself around manufacturing and maybe, kind of recalibrating what they want to do on the design front, we're seeing, like I said, companies like NVIDIA expanding not just their GPU or AI compute, but their networking capabilities, as well as their system infrastructure capabilities, and certainly software, tying all that together. So AMD over the last 6 to 8 months has put in quite a few acquisitions, almost $1 billion worth of software specific acquisitions, and then recently quite a large acquisition for the company, multi-billion-dollar deal on a systems company, a company that's expert in engineering services and putting together so-called rack scale AI infrastructure. And why is that important? That's important because that's where the market is moving. The market's moving to, like I said, much, much larger clusters of training compute, and having systems expertise and the ability to put these systems together quickly that can be validated quickly and put into network as the demand for capacity continues to go up and to the right, I think is going to be a differentiator. And so I wouldn't say AMD necessarily is catching up to NVIDIA overnight, but certainly it sounds to us, looking at these acquisitions, that that's where the company's strategy is focused, trying to become a number 2 player to what NVIDIA has established in generating, a lot of revenue from, like I said, not just compute, but overall AI infrastructure. And I think that's really interesting as we think about the next several years.
Ruben Roy from Stifel, thank you so much for taking the time. We certainly covered a lot of ground here, and there's more that we'll have to dig into later. Appreciate it.
Sounds great. Thanks for having me.
Stick around. Much more market domination still to come. We'll be right back.
The 2024 U.S. presidential election is drawing near as millions of Americans get ready to cast their votes. One financial brokerage is seeking to offer a betting market for the upcoming elections. Interactive Brokers looking to allow users to place wagers on the election outcomes, but legal hurdles remain a pain point for this betting avenue. Here with more is Interactive Brokers founder and chairman Thomas Petterfy. Thomas, it is great to see you. So you want to create a market, Thomas, where investors can bet on the presidential election. It does sound like this got kind of messy quickly, Thomas, headed to court. Can you just fill us in quickly here on what is the current legal status, Thomas, of all this?
Okay, so the CFTC was trying to say that election betting or election wagering is illegal. The judge came out to say that this is not gambling. The CFTC appealed for a stay. The judge declined the stay. The CFTC appealed to the appeals court, and the appeals court is going to make its decision on this Thursday. They will either decline, as this is an administrative stay currently. They will either decline the stay or they will go ahead with the stay. If they go ahead with the stay, it's unlikely that these contracts will be traded before the elections. But the likelihood is that they will refuse the stay.
Okay, so we'll get the update hopefully later this week whether or not this can move forward. How would election betting impact a company like yours?
Well, from our point of view, the election betting is important because it would bring people to the platform. The platform's purpose is really to list contracts on forecasting economic and climate indicators, because that is going to be the long-term essence of this platform. Forecasting economic indicators, which come out all the time, as you know, and these indicators and at what level they resolve is a continuous topic of your platform. So people being able to take positions or yes or no of a certain economic indicators exceeding certain levels is very important. And similarly, climate change is, I think, is a very important subject, and it is what we have currently is people are either deniers of climate change or they are enthusiastic about it, and this is a ridiculous way of going about this existential issue. I think we should come together, and this platform will enable us to create a consensus opinion by which we will be able to gauge what people really think on the average and how urgent these problems are.
Thomas, Interactive Brokers is the only one moving into this area, creating a market where investors can bet on presidential elections. There are others. You'd have competition. What would be your competitive advantage, do you think, Thomas?
Our competitive advantage would be that we have already over 3 million customers on the platform. And as I said, our aim, so there are two basically competitive advantages. One is that we're listing long-term contracts for 10 years out on the climate and on national debt and these existential questions. The second advantage is that our contracts pay interest, 0.5% under the Fed fund rate on the closing value of the contract each and every day. So while you may not want to buy a contract, a forecast contract on something that will not resolve for 10 years, you will, if you realize that as long as the contract moves in your favor, you get this daily interest on an ever higher value. So it is possible that you may say that the national debt will exceed such and such number in 10 years, and you buy that contract for, say, 20 or 25 cents with a payoff of $1 in mind. But as the contract moves in your favor to 25, 30, 35, 40, 45 over time, you get daily interest on that closing value each day. So such a contract could resolve $3 and change in your favor on a 20 or to 30 cents investment.
Well, Thomas, we'll be waiting to see if this offering can make it through the U.S. legal system. Thomas Petterfy, thank you so much for your time. Appreciate it.
Thank you very much.
Amazon CEO Andy Jassy writing a memo today instructing corporate staffers to spend 5 days a week in the office. And Josh, this is a significant reversal of their prior in-office requirements, which was at least 3 days a week. The company is giving employees until January 2nd to start adhering to this new policy. Now, part of this memo, Jassy said, quote, before the pandemic, it was not a given that folks could work remotely 2 days a week, and that will also be true moving forward. Our expectation is that people will be in the office outside of extenuating circumstances. The company is also going to be adjusting its corporate structure, so having less managers, not as top heavy, which I feel like is something we typically see for a lot of these big tech names, but just interesting to see this reversal.
Yeah, you would imagine there would be some number of Amazon employees too who would say, no thanks. Like, right. I'm not coming back. I really like this hybrid thing. And I guess Amazon obviously prepared for that and would say, well, you know, go with God. That's our company, our culture. And it's a hard charging culture over there. I mean, that's the truth.
Totally. And we did see a big surge of hiring throughout the pandemic. So you wonder what this could mean when you think about if employees do not want to adhere to that policy, if they quit, if there's a lot of turnover, just something that I think a lot of big companies are really weighing right now.
For sure. All right, coming up, pre-order results for Apple's iPhone 16 show some major concerns. We're going to speak to an analyst about the tech giant on the other side. Stick around. More market domination still to come. Apple shares under pressure here as investors weigh signals on weak demand for the tech giant's new iPhone 16. Analysts noting delivery times for the new iPhone 16 Pro models indicating weaker than expected demand. According to TF International securities analyst Ming-Chi Kuo, first weekend pre-order sales for the iPhone 16 series estimated to be about 13% lower from last year's iPhone 15 series first weekend sales. Here to discuss is Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Tom, it's good to see you. So the reason this report, listen, it made some headlines, Tom, because it is Ming-Chi Kuo, and he is a well-known, well-respected analyst. If you live in the world of Apple, you know the name Ming-Chi Kuo, and he does look over the pre-order data, Tom, and warns of weaker iPhone 16 demand. Just interested in what you made of these reports, Tom.
Sure, Josh. So I think the challenge for Apple, as reflected in those reports, is that they're trying to get a consumer to buy new hardware, which is coming out in the month of September. But the best selling point for that hardware, especially for consumers in the US, Apple Intelligence, the AI-related features, those aren't coming out until beta next month. And then it's more challenging for sales in Europe and China, where the AI-related features are coming next year, perhaps later. So I think that I'm not surprised that you're seeing a slow start for the 16 lineup on this gap between the hardware and the software.
Can I ask you, Tom, though, can you look at pre-orders historically as a good gauge of demand?
I think so. I think that the pre-orders are an indicator of to what extent consumers were, especially like pent-up demand, which is, I think, another concern I have on the AI story for Apple. If you compare that with the 5G story, where there clearly was a lot of pent-up demand. So yes, I think pre-orders are a good data point.
The bottom line, Tom, for investors still trying to make a decision here, make a call of whether the new iPhone 16 series is going to, create a meaningful jumpstart for an iPhone upgrade cycle. I think last time we talked to you, Tom, I don't want to mischaracterize you. It sounded like you were a bit cautious on that. Where are you right now?
Yeah, so the analysis we did suggested, or our take is that the upgrade cycle for AI, there will be one, but it'll be half the size of 5G. And we looked at the data for iPhone sales. There clearly was pent-up demand heading into the 5G rollout. And then there's regulatory challenges in Apple when it comes to rolling out Apple Intelligence in Europe, which is about 25% of sales, and in China, which is 19% of sales. So yes, upgrade cycle, but half as significant as 5G.
And what do you say, Tom? I've talked to some bulls who, I think a big part of their thesis is just the sheer volume. I mean, hundreds of millions of active iPhones out there that, according to their number crunching, are at least 3 years old. And so when I talk to them, they say that's really it. Like, that's just a lot of people who are waiting for an upgrade. They're going to like the faster processor, the battery, the camera. What's your response to that?
My response to that is that each year, Apple essentially upgrades the processor speed, the camera, a lot of those features, and it hasn't necessarily pushed the needle on an incremental amount of consumers upgrading their Apple device. The good news for consumers is the devices hold their value, last a long time. I think there'll, again, be an AI upgrade cycle. It's just going to take time, and it isn't helping the company that there's this gap between the hardware and the software.
Do we know, Tom, how excited consumers actually are about these new AI features? Because traditionally, you would upgrade your phone. It's actually based on the hardware, right? It's the processor, the battery, the camera, maybe a new design.
Yeah, so I think that there is interest from consumers in AI-enabled phones. If you look at the advertising from Samsung or you look at the advertising from Apple, I think there's some element of education here. They're trying to explain the new functionality that AI is going to bring to a smartphone, either making it better for you to use your calendar or summarizing emails, things of that nature. But yeah, I think that you'll see an upgrade cycle. I just think it's going to take some time.
Final question, Tom. Any line of sight to how these new AI-enabled iPhones compare and contrast, Tom, to what rivals offer, the Googles, the Samsungs?
I think, again, the big selling point to the consumer will be being part of the Apple ecosystem versus Android. So I think that's at the same time, Josh, I'm monitoring the potential for the flip iPhone and things of that nature. And consumers who may want that form factor, the foldable phone. That also could be softening sales for the 16 lineup. But yeah, hard to say on the Apple versus Android, other than wanting to be part of the Apple ecosystem versus Android.
Tom, always great to have you on the show. Thanks for joining us.
Thank you, Josh.
Now let's get to some calls of the day, sponsored by Tasty Trade. Evercore raising its price target on Carvana shares from $142 to $157. The note highlights the company is well positioned for growth in the used car space, calling out a, quote, positive catalyst path for the next 1.5 months, which could include a potential beat and raise for the third quarter. Now, the analyst, Michael Montani, he met with Carvana's CEO and CFO last week, which is really the catalyst for this price target raise that we're seeing. And during that meeting, Montani said that the leadership team is focused on, quote, delivering a great customer experience to drive sustainable share gain while eliminating pain points along the way. And this is really a big vote of confidence for a name like Carvana. Remember, back in December 2022, Carvana was actually Yahoo Finance's worst company of the year. However, we've seen shares really climb back here over the past year. It's up around 200%. Same with those year-to-date gains. And the stock currently has 8 buys on the street, 13 holds, and just 3 sells.
Yeah, analyst sees a long runway, he told clients, for efficiency gains across its P&L. Margin benefit he talks about from improvements in advertising efficiency as they scale up the business. Price target goes to 157. Average target on the street is 155 per Bloomberg. All right, moving on. Piper Sandler lowering its price target on e.l.f. Beauty from 260 to 162. Despite the price cut, firm reiterated its overweight rating, saying buy on the weakness. So analysts at Piper, the target does go to 162. Tell their clients, Allie, they hosted a dinner and investor meetings with e.l.f. Company execs were there. Overall, we came away slightly less optimistic on the magnitude of the 2025 beat that could be possible, they say, just given some macro softening, weaker back to school. However, we still remain confident, they went on to say, that the high end of management's outlook is achievable on both the top and bottom lines, still leaves room for upside opportunity.
Right, and that macro story, we've been talking a lot about this bifurcation of the U.S. consumer, that lower income versus higher income consumer, the lower income consumer pulling back here. When you think about e.l.f. Beauty in comparison to some of those other luxury beauty brands, it is the more affordable option. So I think this is just going to be one of those stories that we're going to have to continue to track down the line and develop as the valuation story develops as well.
Yeah, stock is down about 20% this year. Analyst says, though, this may not be a 50% plus growing year as some bulls were hoping for, but the valuation contraction, they say, looks well overdone.
Yes, we'll have to see when we get those updates on the next earnings season, too. Finally, Zillow snagging an upgrade today from Wedbush. Analyst Jay McCanless noting that falling mortgage rates, along with the company's software and services business, could act as positive catalysts ahead. The stock today rallying toward more than a 2-year high. And the analyst raising his rating on the stock to outperform from neutral. Share price boost to $80 a share from the prior 50. So lots of upside potential there. And the housing sector, look, it's a big one that we talk about when we look ahead to interest rates and whatever decision the Fed sets on Wednesday. A lot of experts that I've been speaking with have told me that the expectation of a rate cut is already priced into mortgage rates, which is why I've been seeing that steady decline. But for a name like Zillow, it's all very interconnected. Shares, as we mentioned, heading for their highest price since February 2022. And it's not the only real estate related name that's seeing a boost today. We're seeing Redfin and Remax rising as well.
Yeah, stock hits a 52-week high in today's trade. The analyst Jay McCanless, who friend of the show, we've had Jay on a lot, talks about the potential positive catalyst of lower mortgage rates for Zillow's brokerage business, says the company's software and services initiatives adding possible upside to his estimates. Says, here's really the money quote, I think, of the note. We believe the SNS offerings, along with Zillow's core brokerage revenues, have allowed total revenues to grow faster than the national existing home market for several quarters. Does increase his 2025 estimates. Stock hasn't done much this year, Allie. It's about 7%. The street's pretty divided, 4 buys, 4 holds.
Yeah, and I think a lot of this will have to do what we see from the Fed, how this continues to impact the housing market, the affordability issues that we've seen. That's been a big issue where people are locked in, priced out, and we'll see if mortgage rates falling, if that moves the needle in any way.
We weren't locked in low, by the way. No, we went in high.
It was bad.
No.
We went to refinance.
Refinance. Good for that. All right, while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned tuned for market domination overtime.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
That's the closing bell on Wall Street. And now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's trade. But let's first see where the major averages ended up. And we're looking at a mixed bag on Wall Street, although the Dow Jones was able to eke out another record here, closing about 0.6% higher. The S&P 500 was able to rally into the close a little bit there, up about 0.1%. We were pretty negative throughout the trading day. And then the Nasdaq, the only major index to close in the red, down about 0.5%. This was largely due to shares of Apple that closed down about 3% lower after pre-orders for its new iPhone shipment fell short of expectations there. But now I want to head over to Jared Blickery for a closer look at today's sector action. So Jared, what are you watching?
Yes, thank you indeed. Really interesting day from a sector point of view in terms of record highs alone. And let me just show you what we've got on the board. Only two sectors in the red. The worst was tech and also consumer discretionary. There you're going to find some of those mega caps, but look at financials up 1.2%. 1.3%. Energy up 1%. And then the record highs I was talking about, communication services, utilities, healthcare, and I believe materials is in there too, and staples. So just a lot of really interesting breadth and strength to the market right now, but not in tech. So let's take a look at some of our leaders index, and Bitcoin is actually right at the bottom there, along with semiconductors, the Mag 7 not doing well, ARC components, so both profitable and unprofitable tech not looking the best. And let's just delve inside the semiconductor heat map. We got ARM down 6%. That's one of the biggest losers. Micron down 4%. And then we'll close here with ARC. And we're seeing more green than red, but some of the biggest players in the red, that'd be Tesla down 1.5%. Also perhaps accounting for that consumer discretionary sector reading that led it to be second to last. I have a little bit more time, so let me just see what's going on in the Nasdaq 100 here. Kind of a mixed board, but in the mega caps, I do want to point out Apple down 2.5%. Got some choice words we're going to be talking about with Josh in just a few minutes, in about 30 minutes actually. And just besides the broad chip weakness, we are seeing Intel up 6%. That's some idiosyncratic news with respect to that semiconductor, but one of those few rare days where Intel is leading. Josh.
All right, thank you, Jared. When the Federal Reserve meets Wednesday, officials are expected to mark the end of an era as they cut interest rates for the first time in 4 years and chart a course for lower rates over the next 2 years. And joining us now with more is Yahoo Finance's very own Joshua Schaefer.
Hey, Josh. Yeah, so it seems like we've had a market shift over the last couple days, right, as far as what markets are pricing and expectations coming into that meeting. So over the past couple days, we've seen a pretty heavy shift into traders now favoring a 50 basis point cut. That's now at 63% on the CME Fed Watch tool. That's up from a 30% pricing as of a week ago. And really what that shift tells me is we were talking just last week, Josh, about how that big cut could be ominous for markets, right? And at that point, we were talking about it because it would be a surprise. Markets were not pricing in this 50 basis point cut. I think maybe we're getting to a point now where because it is getting closer to priced in, it's hard to worry that that necessarily means panic. It feels like the take is out there that we might need 50, that we can accept 50. So maybe 50 just isn't that bad and 50 isn't going to be...
Learn to love 50.
It's fine. 50's fine.
Why was there a change, though?
Such drastic change, too.
It feels like the change came from a couple reports that came out, right? One from the Wall Street Journal. And
Nick
one
Timiraos.
Yes, and one from the Financial Times, essentially saying that the central bank feels like this is a very hard decision and that it is going to be close.
Close call is how the Journal put it, yeah.
Close call, right? And so you saw markets move on that, and then it felt like the right opportunity for everyone that had been leaning 50 anyway to come out and say, yeah, we think it's time to get this low.
I saw that Nick Timiraos headline drop. I remember, and I was like, this is going to move it, because that dude is smart and I'm telling you, he's like a shadow FOMC guy. He is. You knew that was going to move it.
Well, what's interesting too, and this is from your article, that if the market goes 25, especially because right now they're leaning 50, could that be seen as maybe they're being more restrictive instead of easing and at the level that investors really
So it gets into how expectations move rates, right? But essentially Neil Dutta over at Renaissance Mag, the head of economics over there, highlighting that since we've gotten to a point where we're pricing 50, if we actually only get 25 and the Fed is a little bit more hawkish for the rest of the year, you're going to see rates come back up, and maybe that's not a welcome move for stocks. And Greg Dacco was pointing out that you would have to see rates come back up. He was pointing this out on our morning show, and generally a repricing of rates. So you're getting to a point now where the market is expecting 50, the market is expecting 100 this year. So you'd actually see yields probably higher. The key, though, and sort of the kicker here is going to be no matter what way the Fed goes, it seems like the market is really priced for a soft landing right now, right? And if Chair Powell can say, we're cutting 50, but we're cutting 50 because we want to get in a good place, but we feel good about the labor market. We're not cutting 50 because we're worried about the labor market. If that growth story remains intact post-Wednesday, then that seems to be sort of the key for stocks.
Right, it's going to all come down to the language in that post-decision press conference from Jerome Powell. So
I would have, Josh, this isn't like a question because you're like the markets guy. But one question I'm going to ask Greg Ip from the Journal because we have him on. I do wonder political ramifications. I realize Jay Powell will say
they don't get involved in politics.
I know
they say it all day long.
I get they're apolitical. But I just wonder, can you really do 50? when you're just weeks out from when we all go to the voting booth? I don't know the answer to that, but or would that
Oh,
really?
they can.
They
can.
But would it
They
just
100%
totally
can.
risk your narrative that we are neutral politically? We are sitting on the fence. I don't know. I don't know the answer to that.
We're going to find out.
I'll ask
2:00 on
Greg. You
Wednesday.
know what? We're going to ask our next guest. We'll
All
tell
right.
you what he says.
I'll be tuning in.
All right, well, we'll have to get you back, Josh, to see whatever we find out from Greg. But
Yes.
thank you so much, Josh Schaefer. Appreciate it. Markets are on edge ahead of the Fed decision Wednesday, and that includes bonds. The 10-year yield edging lower as bets on a 50 basis point cut keep rising. Joining us now is Guy Labat, Janney Montgomery Scott, head of fixed income. So we were just talking about it. The big debate right now, 25, 50. When it comes to the bond market, does it matter the size of Wednesday's cut?
Well, to some degree, right? The action, or what we're going to see on Wednesday afternoon, is just one FOMC meeting. But depending on how it's framed, it also casts the next few meetings in its path as well. So for sake of argument, right, we could see a Federal Reserve which comes out with a 25 basis point rate cut, but emphasizes the possibility, maybe even the probability, that over time they could cut at a more accelerated pace. I don't think those are the exact words they would use. But were that to happen, right, we'd see, okay, this one rate cut done perhaps on the hawkish side, but the future would end up pricing each additional FOMC meeting with a roughly 50-50 chance of 25 basis points or 50 basis points. And it would end up being a dovish 25 as opposed to a hawkish 50 in which there's a cut and a more gradual expected path.
You know, Guy, another question. We were just talking to our colleague Josh Schaefer about this. The odds of 25 and 50 were pretty evenly balanced, and now actually a shift to 50. Why that shift, Guy? What changed? I know there were some high-profile press reports, but walk me through why you think that occurred.
Yeah, so I heard you talking about the couple of press reports that were on Friday from the Journal and also the Financial Times. Of course, read those. I will say that in comparison to situations several years ago, in which Fed officials were concertedly making a point to these publications, the language in the two press reports last Friday seemed a lot softer. It seemed a lot more, it could be this or it could be that. It didn't seem like language that in 2022 and 2023, when the Fed was prepping markets for supersized rate hikes, that message that they were signaling, that was a much more aggressive tone in the press reports. So I don't think there's really all that much there beyond preparing for that possibility. You know, one thing I think that is understated in this circumstance is that there's a certain momentum to short-term trading. And it only really requires a few basis points or a few large-sized trades to skew the odds of a 25 or a 50 basis point rate hike at a meeting in the very near term. So I think probably what you're seeing is more momentum rather than aggressive positioning ahead of a 50 or a 25 basis point cut for next Wednesday.
And you say the U.S. is likely to have a very normal Fed rate cutting cycle. What's normal in your view? Because we've been operating in an environment that feels very not normal.
Yeah, I mean, look, the last rate cutting cycle was amidst a global pandemic. And, many of us were concerned about our own personal lives at that time for obvious reason. And the financial wheels were coming off the bus in real time. At that time, there were extraordinary measures taking place. But there have been a long history dating back well prior to the global financial crisis of normal rate cut cycles, in which the Federal Reserve, after reaching some peak and inflation decelerating, begins to lower rates. Unfortunately, many of those cycles end in an economic downturn. I'm not convinced that's going to happen this time. There's certainly a chance, but I'm not convinced it's going to happen. Typically, in mid-cycle corrections, the three that at least the Federal Reserve has successfully implemented in 95, in 97, 98, and again in 2019, have been a series of 3 rate cuts, each of them 25 basis points, and then a pause. Now, I think today we start in a circumstance in which we're much further away from neutral interest rates than in any of those periods. So more likely than 3, we get 4 or 5. But so long as economic growth holds up, if we get 4 or 5 25 basis point rate cuts in the next 2 to 3 quarters, that's a pretty healthy situation. I think it frankly sets the opportunity for a leg higher in risk assets like equities on the other side of that.
Can I ask you a different question as we head into this meeting, Guy? I'm also curious what you make of the Fed's credibility here. You know, it did get dinged. I'm wondering if you think there's been an improvement there. What grade you would give the Fed?
Well, I'm not a professor, so I don't grade them. But I will say that I think like academics talk about credibility very differently from sort of the financial media. So academics would talk about credibility as whether when the Fed says they're going to do something, do they do it? Does it affect markets? And is the result of that roughly what they expect? That's very different from the sort of popular perception of Fed credibility, which is, are they right in their forecasts? And there have been numerous times in the last few years in which the Fed's primary forecast, as distributed in the summary economic projections, the dot plots, was not right. And that's going to be the case with any economic forecast for sure. But in terms of whether the Fed has control over the interest rate markets when they need it, whether they follow through with the actions that they say they're going to take in a concrete way, they have absolute credibility in that sense.
And Guy, there's been a continuous expectation that the Fed is going to cut interest rates, which is part of the reason why we saw the yield curve uninvert. We talk about the yield curve all the time, whether or not it indicates a recession or not. Since this easing cycle is expected to begin on Wednesday, what are your expectations for the yield curve moving forward, and how should we really look at and analyze those moves?
Yeah, so at the beginning of this year, really the end of last year, in our 24 outlook, I published a comment that haunts me a touch, I will say, that I had greater confidence that the yield curve would steepen towards the middle to end of 2024 than I did in the level of interest rates presented in those forecasts. Well, it took a long, long time, but we do look like we're in a little bit of a steepening trend here. Based on how far the front end of the yield curve, call it the 2-year portion of the yield curve, has fallen, any more steepening from here realistically is going to require 10-year yields or the longer portion of the yield curve to rise. And that only really comes alongside a little bit of a reflationary impulse. I don't mean that in terms of inflation, but in terms of growth expectations. So we could get that in the form of greater productivity gains over time, and essentially what's been popularly termed a soft landing, or the avoidance of an economic downturn in 2025. And so I think that's really the next stage of yield curve steepening, is about long rates moving somewhat higher from here.
Well, we'll see what happens on Wednesday. Guy Lebas, thank you so much for your time.
Thank you, Ali.
Just moments ago, Intel and Amazon Web Services announcing a co-investment in custom chip designs under a multi-year, multi-billion-dollar framework. This is a significant expansion of the two companies' long-standing strategic collaboration. Joining us now with more on this is Yahoo Finance's Dan Halley. And Dan, we're seeing Intel shares up more than 10% after hours.
Yeah, Ali, it's not really going to be the fix that Intel needs as far as, well, at least Intel investors need. They're off about 60-something%, or we're off about 60-something% last week, year to date, with their stock price. But this kind of collaboration is important for Intel as it builds up its foundry business, which is basically a spin-off, or a new segment, I should say, that they built out, where they're not only going to be building chips for themselves, but for third parties. And so this is a kind of example of that with Amazon. It's going to be building AI fabric chips on the Intel 18A platform. That's one of the ones that they have set up. Microsoft, by the way, is also going to be building a custom chip on that, as well as custom Xeon 6 chips. And so this is all for data center, for AI. And it is a big deal for Intel to be seeing more customers come in on this foundry side of things. The important thing is how many more they can add over time. They're really trying to take on TSMC, is what they want to do, and become a foundry for a lot of other companies. It's going to take a long time for that to happen, especially as they're dealing with so many financial headaches at this point. Their last quarterly earnings, they cut their dividend. They had lower than anticipated guidance. And so not a great look as far as the financials go in the prior quarter, but this is an important development for them.
Yeah, on that point, Dan, we've spoken to a couple different smart financial analysts who cover Intel, and they've been sort of, I think, suggesting that CEO Pat Gelsinger was in some ways on the hot seat, with the stock under the kind of pressure it has been. I'm just curious what you think this news means for him. How much of a boost in the arm is it for Pat Gelsinger? His leadership, his tenure, his strategy there.
I think this is exactly what he needs. Look, I mean, Intel was losing to AMD as far as capabilities go. They're turning that around. They obviously were losing to TSMC as far as just the sheer amount of chips that are built. They weren't really the vanguard of the chip industry anymore. And so that's what Pat Gelsinger is trying to do here. Obviously, it's costing a lot of money. They're building out different facilities across the world. That takes a lot of cash. And when they're not performing as well on the sales side of things, that obviously doesn't equal success. And so, in addition to this, they also recently announced their latest laptop chip. They're facing competition from AMD as well as Qualcomm on the mobile side on laptops. And so this new chip is supposed to be able to combat that as well as Apple's capabilities. The PC side is really still their bread and butter. And so any success there is going to benefit them greatly. And so, it seems there are kind of little starts to Intel's turnaround showing up here. Investors just have to agree. And obviously, if anybody steps in and says they have a problem with the CEO, that would be an even bigger issue.
And we got another one for you, Dan. Microsoft also making news today with its Copilot AI. What can you tell us there?
Yeah, this is Copilot AI is essentially Microsoft's productization of AI for not just consumers, where they have their AI Plus PCs, which is just, a wild name that people will not go to Best Buy and ask for, but for the productivity side of things, for the enterprise. And so they are doing what's called Wave 2 for Copilot. And that includes things like adding new capabilities to the productivity suite, Microsoft 365, that's Excel, PowerPoint, Word, Outlook, Teams, OneDrive. They're all getting new features, as well as this new kind of AI Copilot Studio option that will allow regular users to basically build a smart agent. So smart agents, think of them as almost kind of like bots that you would be able to put together. Say, for instance, if you have a company and you're going to be onboarding new employees and you don't really want them to have to search through a million different documents for their healthcare information. You can quickly put together a bot just by typing in plain English what you want it to do, point it to a directory of information, and then once a person signs on and they start looking for information for their healthcare data, they'd be able to use that, and it should theoretically give them all the answers they need, or at least all the answers that information provides. So they're clearly in this mode where they're trying to monetize more and more of what they have as far as AI goes, and they need to. I mean, they're spending billions of dollars on this, as well as Google and Amazon, but Microsoft's competition here is pretty fierce as far as Google goes and their productivity side, Salesforce and their own productivity side, and AI. So it's another good move for Microsoft. We'll see how it is received by those customers.
Thanks, Dan, for your insight there. A lot of big tech headlines. Appreciate it. Coming up, is streaming now a good business? We'll answer that question and more when Market Domination Overtime returns.
Welcome back to Market Domination Overtime. Let's do a quick check on how the markets closed today. Sponsored by Tasty Trade. Mixed day. Dow up 228 points today. That did hit both intraday and closing records. Just looking over the other indexes, the S&P 500 up about 0.1%. Tech-heavy Nasdaq is down about 0.5%. Of course, this all coming as investors wait for that big Fed policy meeting in which the expectation is our central bankers are going to cut rates for the first time since 2020, Allie.
Well, whether traditional media likes it or not, streaming is the future, but only a few legacy companies and newcomers are well positioned enough to achieve profitability and scale. With me now to discuss the state of the cable bundles, streaming, and more is Robert Fishman. He's a senior analyst at MoffettNathanson. And Robert, I want to start on the state of cable, since there's been a few developments on that front. We just saw Charter rolling out new pricing, finally a resolution between DirecTV and Disney. So to start broad here, what's your biggest takeaway when it comes to the future of this cable bundle, given all these recent developments?
Sure. Well, first of all, thank you for having me. Clearly, we're in a time of disruption, to say the least, and the traditional cable bundle is going through that almost every day. We see a new headline, as you just mentioned. We've seen Warner Brothers Discovery strike their deal 1 year early with Charter. We've seen now DirecTV and Disney finalize their deal after a little prolonged blackout. So there's continued deals that are evolving, and how these deals are, the terms of these deals continue to shape the future of the landscape. And now that the companies are looking to include streaming within the offering to the subscribers that they have, because they're looking to try to keep as many as possible with those different offerings.
And I want to pick up on the Disney DirecTV deal. The two sides referring to their resolution as a, quote, first of its kind collaboration. But it was a particularly tense negotiating period. So which side emerged as the true winner here, in your view?
Well, we're still trying to dig into all of the details to help us find that answer. But I think it's clear that the leverage was largely on the side of Disney, given that DirecTV doesn't have the same broadband business that Charter and others have that they can help lean into when negotiating. And given that DirecTV is more of a sports-led type of offering to their subscriber base, it was interesting to us that the deal was able to take place just before the college kickoffs.
Mm-hmm. And earlier today, you and the team at MoffettNathanson published a new note titled, "Is Streaming Now a Good Business?" And you say, in short, it comes down to the players that have the ability to scale. So who are those players?
Yeah, thank you. So we've been on this topic for a little while now, and we had a point of view a couple years ago that streaming was not really a great business. And clearly Netflix has proven that it is a pretty good business for them, and only getting better as they continue to grow and scale and monetize their subscriber base in different ways. But the question is, can any of the traditional media companies try to replicate that success? And we do have the confidence that Disney has the ability to do so. We think there's steps that they need to take in order to make that story probably more clear to their investor base. But it's also at the same time pretty clear to us that the other platforms are still in the middle of a very difficult transition. Coming back to your first question, given that the linear dollars that the cable bundle generate for them is going away quickly, and they need to pivot to this streaming platforms. But unfortunately, we just don't think it's big enough to scale at this point.
Another headline I want to get your thoughts on is the Rupert Murdoch succession battle for Fox, that court fight beginning today. How do you see that battle playing out, and how much of a risk is that for a company like Fox?
Yeah, I mean, for Fox, it is, as far as the future goes, we've long held the view that the future of Fox is likely not to remain an independent company. And that obviously this will play into how that proceeds, given the potential change as far as the trust goes. But as far as the fundamentals of the company go, they're still very much in a different camp, back to the streaming question, because they have Tubi and they're not playing the same game. So we think that they have assets that are still being undervalued within their broader portfolio, including Tubi and including other assets, even on the sports betting side, where they have their 18.6% stake of FanDuel. So it's going to be interesting the way that all of this plays out and how this could impact the future potential of this standalone company.
Yeah, so certainly a lot to look out for in this industry. Robert Fishman from MoffettNathanson, thank you so much.
Thanks for having me.
Time now for What to Watch. Later tonight, former President Donald Trump is hosting a live stream on X Spaces at approximately 8 p.m. Eastern. He's expected to announce the debut of a new cryptocurrency exchange called World Liberty Financial, and the platform would be controlled by Trump's sons, Donald Trump Jr. and Eric Trump.
Now moving on to Tuesday, September 17th, we'll be getting monthly U.S. retail sales in the morning. Economists are forecasting a 0.2% decrease in the month of August. This comes after retail sales rose more than expected in July. The data will give us some more insight into the health of the U.S. consumer going into Wednesday's FOMC meeting.
Moving over to housing, lots of new housing data this week, starting with homebuilder confidence. New number for September is coming out in the morning. Economists forecasting that to tick up to 41 after 4 straight months of declines as elevated mortgage rates continue to spook potential homebuyers. That's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Investors on edge ahead of the FOMC September rate decision. The tech-heavy Nasdaq fell, the S&P gained slightly. Dow managed, though, to close at a new all-time high. Plus, unprecedented uncertainty. Investors nearly split 50-50 on whether the Fed were going to cut by 25 or 50 basis points on Wednesday. It is the least confident the market has been since at least 2015. The Wall Street Journal's deputy economics editor joins me next to discuss the case for a half-point cut. And TikTok's day in court. Lawyers for the social media app today arguing against a potential ban in the U.S. The Biden administration signed a law back in April that gave the app until January to decouple from its Chinese owner or face a ban amid fears of surveillance from Beijing. We'll discuss what's at stake later this hour. Well, this week, investors are all but certain the Fed will cut rates on Wednesday. But the question, of course, is how much has been hotly debated during the trading day Monday. Futures tied to the Fed's decision swung wildly. By Monday afternoon, investors were pricing in a more than 60% probability that the Fed would cut by 50 basis points on Wednesday. My next guest is firmly in the half-point cut camp. And join me now, Greg Ip, chief economics commentator and deputy economics editor at the Wall Street Journal. All right, Greg, it is great to see you. As always, you think the Fed should cut by half a point. Make the case, Greg. How come?
Okay, first of all, I don't know what they're going to do. And second of all, I think there's a case for both a quarter and a half. But when I review the evidence and the facts, I come out in favor of the half-point cut. And, you know, it all starts out by looking at where rates are now. They're 5.25% to 5.5%. That's the highest in 20 years. Now, when they pushed rates to that level a year ago, they had some justification. Inflation was really high, and they were really afraid it was going to get stuck there. And honestly, they were ready to cause a recession to prevent that from happening. Well, inflation has come down a lot right now. By a lot of underlying measures, it's below 3%. It's in shouting distance of the 2% target. If you look at a variety of forward-looking indicators, I think there's excellent probability that they'll be very close to 2% a year from now. There's no need for a recession now. Having a recession now would be a terrible waste and a big mistake. And so rates just look too high right now for the economic circumstances we have now. They need to get them back to some semblance of normality. Now, whether that's 3%, 3.25%, maybe less than that, I'm not sure, but it's definitely quite a lot lower than 5.25%. And so I would start that process with a half a point just to bring the stance of monetary policy back to something that looks a little bit more logical for the economy that we have today.
What would be the risk, Greg, of cutting half a point as you think through them?
So the biggest risk if you cut half a point is that in the next few months, you get new data that tells you that actually inflation isn't continuing to head down. It's actually kind of stuck here. Maybe it's even edged a little higher. There are certain things out there that we can't predict. Like, for example, what if oil shoots higher again? What if we get higher tariffs in the next 12 months? So those are things that we can't really predict, and I'm not dismissing that the possibility. And if it came along, the Fed would look at that and say, well, looks like we won't be cutting rates as much as we thought we would. But, you know, if they're in that situation, the answer is fairly straightforward. Just don't cut rates the next meeting or the meeting after that. They can, as they like to say, be data dependent.
What are the risks? I guess there would be risk, too, of going for a traditional 25, the norm, Greg, but you must think that's less risky.
Well, no, I actually think that sticking with a quarter point brings more risk.
Sorry, you're right.
To
more
it.
risky. Yeah. I'm sorry.
I mean, ask yourself, so your baseline scenario is that the job market stays fine, growth stays fine, and all that, and if that's what works out, it's fine. A quarter point, nobody's going to complain about that. And if you're asking me, I don't think the world will end if they go by a quarter point. It's perfectly defensible. But I like to think about things that can go wrong. And Fed Chair Powell said in his Jackson Hole speech a few weeks ago that the labor market has cooled and any more cooling would be really unwelcome. And I agree. We're now at a situation where job growth is very, very modest. The unemployment rate has moved up about, 0.75 percentage point. Any more weakening in the job market starts to look very, very recession-like, and you don't want that to happen. And if you look at where we've been going lately, there's a more than zero possibility that the next few job market reports could be very weak and that the probability of recession will then look higher. And if that happens and the Fed has only gone a quarter point, it'll be obvious to everybody, including the Fed, that their rates that they're behind the curve. And then they're stuck in this catch-up situation of having to cut rates more aggressively.
Greg, we will soon find out, my friend. Thank you for joining the show today. I always appreciate it.
All right, then. Thanks a lot.
Stocks closing mixed as Apple pulls down Nasdaq. Meanwhile, the Dow hitting a record close while Fed rate cut decision on the horizon. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. And let's take a survey of what happened today. It was a mixed market in the indices, but as we're saying here, banks surged, Apple, it fell. And that was kind of indicative of the entire tech sector. Chip stocks really took it on the chin. But here's the sector action today. We see financials in the pole position. We see tech in the laggard position here. And what's been interesting to me is to track how things have been doing in the month of August, which I'm just kind of waking up to the first time. I've been out 2 weeks. Thank you for rolling with the punches here. But real estate and utilities, these are two of the top sectors. That's a very defensive look. But if you think about it, we kind of began the month with this big downtrend, and that really skewed things.
Has it been utilities all year long?
You know what's interesting? Here's another interesting. Year to date, we're going to see utilities is in the front spot. That's up 25%. Do you remember a time when utilities was up 25% over 5 years?
Yeah, we had so many analysts pounding the table on this. I mean, really, offense, defense, they would say in one sector.
Yeah, it's really, well, what I like about this play is it's AI related, but it's not directly. So, you know, it ties into the infrastructure of AI. I think we're going to see a lot more of this. And what I really like about it is the low volatility. Let's take a look at this chart real here. I'm going to show you the year-to-date chart. Now, you compare this to NVIDIA, it's going to look quite a bit different. And by the way, NVIDIA is a big part of the trade too, as we know, but I think utilities has a lot to offer. So getting to our second point, we have the Fed. We got to talk about the Fed. What I like about this Fed meeting is that people are talking about 25, 50 basis points. We haven't even had that discussion since 2007. Here's a chart that goes back to 2009. I wish it went back a little bit further, but this tracks the amount of the Fed surprise. So if the Fed actually surprise cuts 25 basis points, okay, that's going to be actually the biggest surprise here going back to 2009. If it surprises with a cut of 50 basis points, that's actually going to be a big surprise to the downside as well. Either way, it just kind of highlights that this is a huge pivotal Fed decision.
Did I hear the yield curve inverted while you were out working on your tan? Is that what happened?
You know, it did. Yeah. And it was maybe directly related to that. The yield curve had been inverted for such a long time. It was a couple years ago. And then only within the last few days has it uninverted. Yeah. But you'll remember, like, it takes up to 2 years. It's something like 18 months to 2 years for that yield curve inversion signal for the recession to take place. Well, that's out the window now. So rest easy.
Final point, Jared Blickery.
All right, we are looking at September seasonality, which is sad. And this was the last thing we looked at the close of August when I was standing here next to you. This is the first 10 days and the last 10 days of each month, the average return in the S&P 500. Here's the back half of September. You're going to notice that is the worst of the year. So that's just an average. That's just what we have to look forward to potentially. But this is kind of the time of year when things pick up again. Well, when volatility picks up again, when the potential for unrest in the markets. And here's the VIX. So here's the cyan is what usually happens throughout the year. It's an average going back to the start of 1990. Here's the purple. We had that big spike in early August. That was right on schedule. We got another spike here, but you're going to notice the trend is higher. So that's a potential warning that we're in this crash season right now.
What happens after September?
Well, I will go back to this chart here. Things really pick up in November after the election. October can go either way. We've had a lot of market crashes in October, but October can go really well as well. And by the way, all this negative seasonality talk, I don't want to skew investors to the downside too much. Anything could happen, but these are just historical probabilities.
All right, Jared. Thank you, buddy. Great to have you
back.
Good
to be back.
Thank you. Stick around. More Ask for a Trend right on the other side. Today, TikTok is making its case in court against a bill that would require it to be divested by its Chinese parent company ByteDance or else risk a nationwide ban. And joining us now is Dan Primack, Axios business editor. Dan, always good to see you. I had a question for you, Dan, just maybe start high level, because you've been obviously following the story, Dan, reporting and writing about it. I'm just interested to get your take, Dan. How strong do you believe that the U.S. government's case is that TikTok does represent, Dan, this national security risk?
So there's two different things. There's the legal argument and then the actual argument. On the legal side, I think it's pretty strong because they have a law passed by Congress and signed by President Biden. So that's pretty strong. The national security piece, the reality is we don't know, and neither does TikTok really, because when you look at these filings that the government submitted to the court for the case that opened today, about a dozen pages of it is redacted classified information. So we've never really had a particularly compelling public explanation of it, but every time you get senators or congresspeople who go into these classified briefings about TikTok, they often come out in kind of lockstep that TikTok is a national security threat.
How do you think this actually then plays out, Dan? I mean, is this the first step? We're gonna head all the way to the Supreme Court on this one?
Well, we'll definitely head to the Supreme Court, because whoever loses right now, in this case in D.C. appellate court, is almost certain to appeal it to the Supreme Court. So that is almost certainly where we end up.
With the CCP, Dan, what's your gut? The Chinese Communist Party, the Chinese government, would they actually ever even allow a divestment, in your opinion, forced by the U.S. government?
I don't believe they would. Now, there's some clever things in theory ByteDance could maybe do to try to assuage that. But no, I think the Chinese government has been pretty clear over the years that if it feels it is in the Chinese government or China's best interest to harm one of its homegrown tech companies, it is perfectly willing to do so. It does not have this kind of reflexive, oh, we have to protect ByteDance because it's one of our big unicorns. And ByteDance, by the way, for those who don't know, it is the most valuable privately held tech company in the world, but TikTok is not all of ByteDance. If TikTok went away, ByteDance could survive. It has kind of a version of TikTok in China and other places, and then it has other assets.
So at the end of the day, Dan, I mean, place some bets for me. Would you, if I asked you to take out your forecasting magic here, would you say, listen, I think this does end up as a nationwide ban?
Well, here's what I think. My guess, and based in part on what we heard from the judges' questions today to TikTok, they were fairly skeptical of TikTok's arguments. So I do think we could get to the point where this divestiture or ban law gets put into place. But what's important to note is the president of the United States does not have to ban it if there's not a divestiture. It gives the president the option to ban it. You've already got Donald Trump saying he would not ban TikTok, and Kamala Harris has not taken a position on this one way or the other. You could say she's part of the Biden administration that has said it would do so, but Axios reached out to her campaign yesterday and then again this morning to ask her perspective on this, and they declined to respond.
What's also interesting, Dan, you do have these bold-faced American investors, big names who are kicking the tires here, say they're interested. It's hard though to imagine ByteDance would ever part with that algorithm or be allowed to. So if they did buy TikTok, Dan, what would they be buying exactly?
Yeah, no one seems to really know, because without the algorithm, that's the special sauce, right? That's the recipe that everybody wants. You hear Steve Mnuchin and others, the former Treasury Secretary who's theoretically put together a group to buy it, say, we could do this without the algorithm, or we could maybe silo off the US piece of the algorithm. But again, this all goes back to, even if ByteDance was to sell, a piece of paper to these investors group, the Chinese government has to approve it. And this goes back to your earlier question. There's no particular reason to think that the Chinese government would be willing to do so, particularly because this isn't just ByteDance saying, you know what, for a variety of strategic reasons, we don't think we should own TikTok anymore. This is ByteDance being forced by the American government to do it. And it's hard to see China abiding by that.
Dan, always love having you on the show. Thanks for joining us.
Thanks.
Yahoo Finance is adding to its growing list of shows starting this Thursday, September 19th. Money Glow Up will break down the misunderstandings we tell ourselves about money. Tiffany Aliche will be your favorite personal finance educator as she helps you transform the way you think about money. Tune in every Thursday at 12 p.m. Eastern. More Ask for a Trend right on the other side. Intel and Amazon Web Services announcing a co-investment in custom chip designs under a multi-year, multi-billion-dollar framework. This is a significant expansion of the two companies' long-standing strategic collaboration. And joining us now to talk about all this is Creative Strategies CEO and Principal Analyst Ben Behair. Ben, always good to see you. So let's get right to this news, Ben. So Intel is going to be making a custom AI chip for Amazon. Give me your reaction to that headline, Ben. How important is this, in your opinion, for the company's manufacturing business?
Yeah, I mean, I think the big win is just a large customer, obviously AWS by name. Intel's also mentioned that Microsoft will be doing some custom chips with them as well. So I think there's positive momentum there in terms of getting foundry wins, particularly in this case for 18A. I think that's been one of the big nodes where both Pat Gelsinger, CEO of Intel, and many others have said, this is the first kind of big scale commercial node that they want to push. And it sounds like, they have a number of customers already announced, as well as it appears there's a lot of interest as well as customers looking for that. So it's a good win for Foundry. I think it sets the stage for more customers, but a good solid step one for adding more customers and getting more revenue to Intel Foundry as they look to make that sustainable and profitable on its own.
I'm just looking, Ben, at the reaction right now in the after hours. I mean, this stock is surging about 8%. Does that move make sense to you, Ben? Is that justified in your opinion?
So I think that's more from a separate note that Pat Gelsinger put out to employees and a roadmap on from one, updating them on the board conversations that happened last week, I believe, and then that there's some plans which includes setting up Intel Foundry as its own internal subsidiary. And why that's important, and this is what I think the news is positive to in some of the stock reactions, is it's not a spin out, but it's essentially as close as you can get to putting the right kind of walls and guardrails around Intel Foundry so that other customers can come in and feel comfortable knowing that they'll have capacity, wafer allocation, and again, that there is a separation of Intel Foundry from Intel's fabless product group. And I think that's been one of the big question marks for everybody analyzing this, is the services side of that business, and it needs to be operated. IFS needs to be operated really as its own entity in order to attract many of these wafer scale customers for 18A and beyond. And this is one step toward inevitably where I think they'll have Intel Foundry stand on its own. But I think the reaction is to that formal independent unit of IFS now being functional within broader Intel's business.
Ben, earlier we had the chance to speak with Stifel Applied Technology Analyst Ruben Roy on whether CEO Pat Gelsinger was really the right man for the job, Ben. And just take a listen what he had to say here.
I think Pat's heart is in the right place. I think he came into a situation that required a lot of heavy lifting, and they've done a lot of heavy lifting. There's more to do. Unfortunately, I think that Pat overestimated the time with which it would take him to kind of complete a large overhaul.
So, Ben, we've spoken to a couple analysts on the street who cover Intel recently and asked them whether Gelsinger is the right guy for the job. And I wouldn't say it was a resounding, yes. What's your take? Do you think he's the right leader, the right executive, and has the right strategy for the chip giant?
I do. I mean, I've never doubted Pat's ability to lead this company. I think holistically, the timeline and the cost to do so was extremely hard. Right? They went through an extremely ambitious undertaking to regain process leadership, and we'll see if it sounds like they'll do that, and we'll see if they do this for product leadership as well. But trying to do 4 nodes in 5 years. 5 nodes in 4 years is essentially difficult and monumentally expensive. But Intel still has very hard technology problems to solve. The entire industry does. TSMC has hard problems to solve. Everybody who makes these chips getting beyond 2 nanometer and below, these are hard technology problems. And I think having somebody like Pat Gelsinger, who is at his heart a technologist and very good and has a history of solving those technology problems with Intel, is the right person to get over what are technological hurdles going forward, as well as some economical ones. And I think that sets the stage for, again, a long-term opportunity where I think, again, we will see 2 companies at some point, an Intel and an Intel Foundry, which one of those he then runs, I don't know. I'm not even going to speculate. But I think for where they are right now, he's the right person because of his vision and his ability to overcome technical hurdles, being highly technical himself.
So real quickly, Ben, a stock higher right now, but it's obviously been under a lot of pressure. I think obviously Intel surprised investors with that financial report last month. What would you say some potential catalysts are that investors could have on their radar for Intel near intermediate term here?
So I think there's two things. I think looking at Lunar Lake as kind of the flagship launch where you're looking to see them regain some process or some product leadership, meaning that it's competitive in areas where Intel's not been competitive in years past. Obviously, performance per watt, having battery life, as well as high performance in a product roadmap that can fit into thin and light laptops and a whole host of other things. And obviously, Intel has said they're committing more priority of wafers to Lunar Lake than they originally intended because they do feel it's going to be a stronger pipe for AI PCs and everything that's going on with AI at the edge. So I think monitoring volumes, and then Intel's profitability around shipping more of those products, even though ASP is going to be a little bit hampered because they're making that product with TSMC. But I think I look at that product as the lens by which we see, do they have product leadership or product parity again? So there's one piece. And the other is process leadership. Okay. And that's taking place, I think, when we look at 18A, both from a process standpoint as well as backside power, gate all around. And I think those are the two bars to see leadership in those two areas.
Thank you, Ben. Always appreciate your time, my friend.
Anytime. Happy to be here.
That is a wrap on today's Ask for a Trend. Have a great night.